Vietnamese dong exchange rate update. What today's USD VND movement means for the economy. Welcome to Iraqi Dinar News, where you receive real and authentic updates about currencies and global economic developments. If you want to stay informed with moment by moment developments, make sure to subscribe to the channel and like the video. Today, we are shifting our attention toward Vietnam and the Vietnamese dong, because the latest USD VND exchange rate movement provides an important picture of where the currency stands right now, how the State Bank of Vietnam is managing exchange rate conditions, and what these developments could mean for businesses, consumers, exporters, importers, and people who closely follow the Vietnamese dong. As of Thursday, the 27th of August 2026, the State Bank of Vietnam has kept its daily reference exchange rate unchanged at 25,611 Vietnamese dong per US dollar. Under Vietnam's current trading band of plus or minus 5%, that reference rate produces a ceiling rate of 26,892 dong per dollar and a floor rate of 24,330 dong per dollar. At major commercial banks, Vietcombank and BIDV were reporting buying rates around 25,910 dong per US dollar and selling rates around 26,290 dong, with both rates down by 10 dong from the previous session. That is the first important point for anyone following the Vietnamese dong. Today's data does not show a sudden monetary policy shock or an extraordinary official repricing. Instead, it shows relative stability at the central reference rate, combined with a modest adjustment in commercial bank dollar quotations. There is also an important distinction between the official reference rate and the rates people may see in financial markets or at individual banks. Vietnam operates a managed exchange rate framework. The State Bank of Vietnam establishes the daily reference rate, while commercial banks operate within the permitted trading range. This means the dong does not simply move according to one single number. Market demand for dollars, import requirements, export receipts, foreign investment flows, interest rate expectations, global dollar movements, and domestic liquidity conditions can all influence the rates seen in the financial system. Looking at today's international market data, the USD VND rate has also been moving modestly lower. Market data showed USD VND around 26,078 on the 27th of August, compared with approximately 26,105 on the 26th of August, representing a decline of roughly 0.10% during the session. That movement is small, but it is worth monitoring because exchange rates are often better understood through trends rather than isolated daily changes. A one-day move of a few dozen dong does not automatically indicate a major change in the Vietnamese economy. What matters more is whether the currency continues to experience sustained pressure, whether the central bank adjusts its reference rate, and whether broader economic conditions begin to change for Vietnamese dong followers. This is where today's update becomes particularly interesting. The current reference rate of 25,611 dong per US dollar is higher than levels seen earlier in August. For example, on the 13th of August, the State Bank of Vietnam's reference rate stood at 25,566 dong per dollar, after rising 27 dong from the previous session. That comparison tells us something important. Even though the reference rate has remained unchanged today, the broader August trend has included periods of upward adjustment. In other words, the dong has been operating in an environment where exchange rate management remains an important policy issue. Why does that matter? Because Vietnam's economy is heavily connected to international trade. The country is deeply integrated into global manufacturing and supply chains, and companies operating in Vietnam frequently deal with both Vietnamese dong and US dollars. When the dong weakens against the dollar, exporters can potentially receive more dong when converting their dollar earnings back into the domestic currency. However, importers may face higher costs when purchasing goods, machinery, components, energy, or other products priced in dollars. This creates a balancing act for policymakers. A currency that becomes too strong can make exports less competitive in international markets. But a currency that becomes too weak can increase the domestic cost of imported goods and potentially create inflationary pressure. This is one reason why exchange rate policy cannot simply be viewed as a question of whether a currency is going up or down. Policymakers have to consider the wider economy. For people watching the Vietnamese dong because of potential future currency appreciation, today's numbers should therefore be interpreted carefully. A stable reference rate does not mean that a major revaluation has been announced, and a modest market movement should not be interpreted as confirmation of a dramatic currency reset. There is currently no basis in today's official exchange rate data for claiming that Vietnam has suddenly announced a large-scale revaluation of the dong. Instead, what we are seeing is continued management of the exchange rate within an established framework. That distinction is extremely important. The Vietnamese dong is not being evaluated only on the basis of speculation. Its actual value is influenced by Vietnam's trade balance, capital flows, foreign exchange reserves, inflation, productivity, interest rate differentials, global financial conditions, and the country's economic growth prospects. Another major factor is the U.S. dollar itself. When the dollar strengthens globally, many emerging market currencies can come under pressure. When expectations for U.S. monetary policy change, international investors may adjust their portfolios, and that can influence currency markets far beyond the United States. For Vietnam, this external environment matters because the country's financial system is highly connected to international trade and investment. At the same time, Vietnam has several structural strengths that currency watchers should keep in mind. The country has developed a major manufacturing and export base, has attracted substantial foreign direct investment, and remains an important participant in global supply chains. These factors can support demand for the Vietnamese economy and, indirectly, contribute to foreign currency inflows. However, strong economic growth does not automatically translate into an immediate appreciation of the currency. This is another area where online discussions can sometimes become misleading. Economic growth, rising exports, foreign investment, and stronger industrial production are all positive developments, but they do not guarantee that a currency will suddenly appreciate against the dollar. Central banks often prefer stability rather than dramatic currency movements. For businesses, predictable exchange rates can be more valuable than a rapidly appreciating currency. Companies need to plan their revenues, expenses, imports, exports, debt payments, and investment decisions. Sudden currency movements can create uncertainty. Vietnam's managed exchange rate approach therefore provides policymakers with a mechanism for responding to changing conditions while allowing market forces to play an important role. Today's 25,611 reference rate and the 26,892 ceiling demonstrate how that system currently operates. The ceiling is not a prediction that the dollar will necessarily reach 26,892 dong. It represents the upper boundary allowed under the current plus or minus 5% framework around the reference rate. That distinction should be understood clearly. For Vietnamese consumers, exchange rate changes can also have practical consequences. If the dong weakens significantly, imported products can become more expensive in domestic currency. Businesses may eventually pass some of those higher costs through to consumers. Imported fuel, equipment, electronics, industrial inputs, and other dollar-linked products can all be affected. On the other hand, exporters may benefit from a weaker domestic currency because their foreign currency revenues can translate into more dong. The economic impact, therefore, depends heavily on the individual company and industry. Manufacturing companies that export products may have a different experience from companies that rely heavily on imported materials. A tourism business may experience exchange rate changes differently from a technology company purchasing foreign equipment. This is why analysts usually avoid describing a currency move as simply good or bad. The better question is, good or bad for whom and under what circumstances? For the Vietnamese government and central bank, the bigger challenge is maintaining an appropriate balance between exchange rate stability, inflation control, economic growth, and external competitiveness. That balancing act becomes even more important when global financial conditions are uncertain. Looking ahead to the short term, the most important signals to monitor are the State Bank of Vietnam's daily reference rate, commercial bank USD VND quotations, international dollar strength, domestic inflation indicators, trade flows, and foreign investment activity. If the reference rate remains relatively stable, while commercial bank rates move within a narrow range, that would suggest policymakers are maintaining controlled exchange rate conditions. If the reference rate begins moving consistently in one direction, however, that could provide a stronger signal that authorities are responding to changing market conditions. The international USD VND market is also worth watching. Current market data around 26,078 to 26,100 dong per dollar shows that the market rate remains close to the commercial bank selling levels reported today, although different data sources and market segments can show different prices. This is another reminder that there is not always one single exchange rate available at every moment. Now let's consider the longer-term picture. Vietnam's currency outlook will ultimately depend on the country's economic fundamentals and the policy choices made by the State Bank of Vietnam. If economic growth remains strong, exports remain competitive, foreign investment remains healthy, and inflation stays under control, those factors could provide a supportive environment for financial stability. But if global demand weakens, imported inflation rises, the US dollar strengthens significantly, or capital flows become less favorable, pressure on the dong could increase. Therefore, long-term currency analysis should focus on measurable economic developments rather than rumors about guaranteed future exchange rates. For people who hold Vietnamese dong or follow VND-related news internationally, this approach is particularly important. There is a difference between a currency becoming stronger because of fundamental economic forces and a speculative expectation that the currency will suddenly be repriced at an entirely different level. A major official change in Vietnam's currency valuation would normally involve clear policy communication from the relevant authorities and would be reflected in official exchange rate mechanisms. Today's announcement does not represent such an event. Today's message is much more straightforward. The State Bank of Vietnam has maintained the reference rate at 25,611 dong per US dollar, while commercial banks have made small downward adjustments to their quoted dollar rates. That stability itself is meaningful. It suggests that, at least for today's session, there was no need for an additional adjustment to the official reference rate. The next question is whether this stability continues. If the exchange rate remains relatively contained over the coming sessions, markets may interpret that as evidence that current policy settings are helping manage pressure. If market rates begin moving sharply away from current levels, attention will naturally turn toward the central bank's response. For investors and currency watchers, patience and context are essential. A single daily exchange rate update can tell us what happened today, but it cannot tell us with certainty what will happen months from now. The Vietnamese dong remains an important emerging market currency, and Vietnam remains one of Asia's significant manufacturing and export economies. That combination means VND developments will continue to attract attention from international businesses, investors, traders, and economic analysts. But the responsible way to follow the dong is to separate verified information from speculation. Right now, the verified information is that the State Bank of Vietnam has kept the 27th of August reference rate at 25,611 dong per US dollar. The permitted trading band remains plus or minus 5%, producing a ceiling of 26,892 and a floor of 24,330. Vietcombank and BIDV were quoting approximately 25,910 for dollar purchases and 26,290 for dollar sales, both 10 dong lower than the previous session. Meanwhile, the broader market data showed the USD VND rate easing modestly during today's session. Those are the numbers worth watching. For the short term, the key issue is stability. For the medium term, the focus will be on inflation, trade, capital flows, interest rate conditions, and global dollar strength. For the long term, Vietnam's productivity, export competitiveness, foreign investment, economic growth, and monetary policy will remain central to the direction of the currency. So, if you are following the Vietnamese dong, today's update should be viewed as a stability story rather than a dramatic revaluation story. The market is moving, but today's movements are relatively modest. The central bank's reference rate is unchanged. Commercial banks have made small adjustments, and there has been no official announcement indicating a sudden transformation in the dong's valuation. That is exactly why it is important to remain informed without becoming overly influenced by headlines that promise guaranteed currency gains. Currency markets are complex, and even experienced analysts cannot guarantee future exchange rates. The strongest approach is to follow official central bank announcements, reputable financial reporting, market data, and broader economic indicators. We will continue monitoring the Vietnamese dong, the USD VND exchange rate, State Bank of Vietnam policy, and the economic developments that could influence the currency in the days and weeks ahead. If you found this update useful, Make sure to subscribe to the channel and turn on notification so you can stay informed about future Vietnamese dong and international currency developments. Thank you for watching. Stay informed, stay patient, and always separate verified economic information from speculation. This content is provided for informational and educational purposes only and is not financial advice or a recommendation to buy, sell, or hold any currency.